Can EIA reports really forecast oil price surges? Imagine trying to predict a sudden jump in oil prices based on reports that focus mainly on supply and demand. That's what the U.S. Energy Information Administration does with its reports. They produce detailed data on how much oil is being produced, how much is being used, and what the inventories look like around the world. These reports are trusted because their production data often matches actual figures closely, making them a solid source for understanding how much oil is out there. But when it comes to predicting sharp price increases, things get trickier. EIA forecasts tend to be cautious. They usually project prices to stay steady or go down slightly, especially in the short term. For example, recent reports have predicted Brent crude oil prices to hover around $50 to $60 per barrel in the next few months. These predictions consider factors like U.S. oil production hitting record highs, OPEC plus countries managing their output, and geopolitical events. Still, they generally show a neutral or slightly bearish outlook rather than a big price spike. When you look at how accurate these forecasts are, they do better than just assuming prices stay the same over short periods of 1 to 3 months. But over longer periods, like a year or more, they don't always outperform simple market expectations or other models. Different organizations like the Organization of Petroleum Exporting Countries and the International Energy Agency have different views. OPEC often expects prices to rise, while the International Energy Agency sometimes underestimates demand growth. This difference shows how unpredictable oil prices can be because many factors influence them, such as political tensions, supply disruptions, and market sentiment. For investors, this means that while EIA reports give good insights into supply and demand trends, they shouldn't be the only tool used to predict price surges. Price jumps can happen suddenly due to unexpected events like conflicts or natural disasters that are hard to forecast. Using EIA data, along with other information like geopolitical news, technical analysis, and market sentiment, can help you better prepare for possible price increases. In the end, EIA reports are reliable for understanding how much oil is being produced and how supply and demand are balancing out. But predicting sudden price surges is a different story. They are more about understanding the fundamentals and being aware of the many unpredictable factors that can push prices sharply higher. So, while these reports are helpful, they should be part of a broader strategy rather than the sole basis for making investment decisions on oil price spikes.